Everyone, welcome back. This is Messari's Unqualified Opinions. I am your host at 2-Bit Idiots. We were gone for a little while. We did one yesterday. We got another exciting conversation today with Dave Weisberger, who's the co-founder and CEO of CoinRoutes. We're going to talk about smart order routing, institutional interest and entrance into crypto, and we might even get into some schadenfreude with respect to regulatory overreach or lack of creativity, along with a side of Libra perhaps. Lots to talk about. I want to let Dave introduce himself, but has a career in the traditional markets and knows quite a bit about market infrastructure, and I think going to be a good conversation as we think about these next 18 months and more enterprises truly coming in, dipping their toes in the water, and then becoming more actively invested in crypto. So without further ado, Dave, thank you so much for joining this, and we'll try to make this interactive. As I know, the last couple episodes we've had people chime in on Twitter, but for starters, why don't we cover the basics here? So talk a little bit about your background.
Yep.
And CoinRoutes and kind of what led you into crypto full time.
Yeah, it's kind of a cool story. I mean, first of all, thank you for having me. It's always a pleasure to talk to audiences about the crypto space. The interesting thing is, CoinRoutes comes from a symbiosis of my background and my co-founder, my son, whose idea it was, Ian Weisberger. In many respects, I feel like deja vu, because my career has been 30 plus years focused exclusively on automation and quantitative trading, mostly in equities. So I started at Morgan Stanley and built program trading systems and technology. I wouldn't trust my code anymore, but I wrote the first program trading system on Wall Street, so it was kind of fun. Moved to the front office and built the global program desk at Salomon Brothers, and through corporate Pac-Man, that ultimately became Citigroup. So was there for like 14 years, and along the way did things as diverse as architected market making electronically and built their systems, but also ran statistical arbitrage and quantitative trading, built their very first blade servers so that you could actually do big data and analyze it. Before machine learning existed, we did very similar stuff, just more by brute force. Left there after spending a year and a half running a company called Lava, which was a smart routing and algorithmic trading company. That was the first company to do smart routing in equities. And Lava is actually interesting and instructive for CoinRoutes because it was founded on the notion that smart routing meant finding the best price, i.e. seeking liquidity and finding the best price. Now in crypto, because the market structure is different, that's actually dumb routing. So what most people do that they call smart really isn't all that smart. It's not different than smart beta. You hear that term in investment management a lot, but really if you talk to the practitioners, most smart beta strategies are really pretty dumb. They're just, I just want exposure to this asset or that asset, so there is nothing particularly intelligent about it. True smart routing, really, it has to dig deep into the market structure. But to understand the rest of it is after I left Citi, I went to a company called 2 Sigma. Was an early employee, 240, it's like close to 2,000 now, and ended up building their wholesale market making business and ran their broker dealer. So along the way, as you can imagine, I've had a lot to do with regulators and running broker dealers and all of this stuff, but have always been in the position of automating trading. So, going from humans to whatever. And what's really fascinating about crypto, and I did a talk a year ago, and people ask me about this all the time, is crypto today, the way people trade Bitcoin, I view it as incredibly ironic that an asset that is supposed to take intermediaries out of the system has more intermediation than equities or FX or options or futures. So clearly there's something weird going on, and what's actually happening is people trade Bitcoin pretty much the same way they traded European equities in the 90s. So in 1995, I was sitting in Victoria Plaza in London building a global program desk for Salomon Brothers, and whenever we wanted to trade something, we'd walk over to our market makers. And the market makers were basically people who would put really wide quotes out into the market on a billboard system called SIAC International. And the asset managers, the big buy-siders of the day, would call them up, trade, get one price, do their whole block, then go to the pub for the rest of the day because their work was done. And that's sort of how things were done in the early to mid 90s in the city of London. But what's interesting about it is that 80% of the volume traded that way. Yet in Germany, in Italy at that point, France for sure, Sweden, Norway, etc., they all had electronic markets. And so there were prices being displayed that were being ignored or kind of loosely followed by the big market makers. That is exactly what's happening in crypto today. And so it's really interesting for me. Now, here's the funny part. 10 years later, 80% of the volume moves. So yeah, that gives the background.
This question has come up before. We've had folks like Bobby Cho on from Cumberland, and Mark from Tagomi. Just give us your sense for where price discovery happens today in crypto, right? Because it kind of feels like it's 50-50 between OTC and kind of what's flowing through to the exchanges, although the exchanges now for Bitcoin and Ether, at the very least, are have quite a bit of liquidity. Those orders ultimately do hit the books of these exchanges at some points. It's a little bit less Wild West and kind of dark pool driven maybe than it was even a few years ago.
Yeah.
But where are we now, right? If it still is mostly, as you said, with European equities, the prices are loosely followed. Is that still the case, right? What's driving?
I mean, there's basically three cross currents that are going on. There are large OTC trades that happen, much less frequent now, much more likely to be more smaller pieces relatively speaking. And even though, when I say less frequent to have big OTC trades moving the market coming out of left field, although it still does happen. Effectively, the other two big cross currents are the liquidity that trades on BitMEX and other futures exchanges and the spot markets. I think that a generalization that we see in the data is that large moves tend to show up on the exchanges deep in the order book before anything else. Smaller moves tend to originate in the futures markets and drive into the cash markets or into the spot market.
Interesting.
And it's not always the case, because I hate making gross generalizations. As someone who spent 10 years running quant desks, I'll tell you, if you get forward correlations of, if you're right 55% of the time, you're a hero, as long as you can manage your money really well. So the reality is that's a generalization, but it does tend to be the case. I mean, clearly there still are situations where people are dumb enough to call 4 or 5 OTC guys and move the market. There's clearly still situations where large sellers are dumb and call intermediaries, but that business is faded or is fading. There's still a lot of OTC desks out there that don't have tools to trade in the market very well. Those businesses, they will all be out of business within a year or two. I've been saying this for a while. I've been, at Consensus, there were at least 3 panels I saw where sentiments like that got made, and they are definitely fading, right? The ability to trade instantaneously without committing your own capital by calling 2 or 3 of the other guys is just, it's a pure middleman function, and that will eventually disappear, right? So my answer to the question is we see it all the time. The last 3 weeks has been very interesting. I mean, if you go back to before today, where we saw some volatility, every time you have a period of calm that starts to establish itself in the market, you could trade $10 or $15 million of Bitcoin, less than 1% all the time. And when the market gets a big spike, of course, that could go up to 1.5% or even 2%. So the reality is the liquidity that's on the exchange is definitely representative of the same market makers that you're calling on the phone, the real ones, as well as smaller, quasi-institutional, pro-trader types, and then some retail.
So tell us a little bit about CoinRoutes and the system you've built and exactly who it's geared towards, because you and I did a demo a couple months ago. I'm sure it's evolved even since then. But it was pretty slick in terms of identifying the kind of size of a trade, what type of slippage you would experience across different venues. I think you also have toggles, or at least the ability for folks that may be in the U.S. or in New York State in particular, like which venues they can actually trade on, right? Even if they're less liquid than.
CoinRoutes is based on 3 patents, and then we've taken it from there. So the first thing that's important about CoinRoutes is we filed for a distributed smart order routing complex, or distributed trading engine. And what that means is we process about 8 terabytes of market data a day. Right now we have 1 node, which is in Amazon. We will, by the end of the year, have nodes in Asia and in Europe. So those central market data nodes are doing a lot of heavy lifting. They're processing streams of data, the full book view of all the big exchanges. We're adding the ones that need to be added, etc. Now, the customers, on the other hand, get a client deployed, a local deployed instance of their router, and that gives them all the functionality, all the views, all the reporting, the ability to send orders, etc. And it works interactively with the market data node. Now, why does this matter? It means we never see wallets or keys. So you mentioned Mark from Tagomi. I've known Greg Tussar for 20 years, and he's an awesome dude, right? We kind of come at the market and cut it almost in half. Clients who want cradle-to-grave service, who want to custody, account, report, trade through one firm, that's Tagomi. Customers who want to trade through one firm but have their own accounts, be able to custody where they want, be able to do their own reporting and all that stuff, that's CoinRoutes. So we're kind of coming at it a different way. But the reason that's important is our clients don't have to trust us with their wallets or keys. And that is a very important selling point. So that's patent number one. Patent number two is for a filtered, consolidated best bid and offer. So if you want to know what's the best price of Bitcoin, there are two things you have to decide. It's like, which exchanges do I believe in, or am I eligible to trade on? So Bittrex, for example, was in one group and got left out of that group because you can't be in in New York anymore. So if you have a non-New York group, you have the people who will take New York accounts. So you can filter in the CoinRoutes system via API or on our screen. You can literally pick of the 40 exchanges or so that we have which ones you want to consider. We also have filtering based on size, because in Bitcoin, what's the best bid? Well, if the best bid is 0.001 Bitcoin on Bitflyer USA, which by the way happens quite a bit, maybe you want to still look at Bitflyer USA if they have something meaningful, but you really want to consider a quote for 0.001 Bitcoin. So we have the ability to filter based off of that. So that's patent two. Patent three takes into account the fact that fees matter, right? The fee differential for an individual client could be as much as 20 or 30 basis points, which on a $10,000 or $11,000 or $12,000 instrument is a very large, hundreds of times the bid offer spread. So we have a fee sensitive benchmark we call real price. And what real price does is it takes a discrete quantity. So it says, let's say you want to know, you're the SEC, and you want to know how a Bitcoin ETF could be traded. So you could look at, in real time, 250 Bitcoin. What does it cost to buy it? What does it cost to sell it? At retail fees, at institutional fees, etc. And it can give you that stream. We have a display that looks at it for the futures contract. So we look at 5 Bitcoin with retail fees. And we can show you what the real fee adjusted bid offer spread is. That's what we use for pre-trade, right? Because that's a reasonable pre-trade benchmark. And what you'll find is that compared to where the OTC dealers quotes, is quite competitive. Sometimes the OTC dealers are well inside because they may have, for example, if they're short and they're trying to buy and you want to sell, maybe they're the best place to go. But if they have no position, quite often it's very competitive with the OTC guys because it's basically a risk-free price. So the midpoint of that is a very, very good price for understanding what the price of the asset is. So that gives you an idea of what CoinRoutes is based on. And then what we did is we said, okay, what's the market structure and how should you trade? So we've developed a parameterized system. It doesn't have to be that complicated. You can just hit a easy button and say, okay, I want to buy it now. I want to buy it on a schedule. I want to buy it stretched out over the next few hours. But we have 14 different parameters to adjust how that will work. We obviously supply defaults for people who don't want to actually think about these things. But we have lots of differentiation in terms of levels of aggression and how you actually do all this stuff.
So because you guys aren't taking custody, is this just kind of software as a service?
It is software as a service.
Are you taking a percentage of is it a fee model?
Well, it's software as a service with a fee model.
With a fee model, okay.
Yeah, and the reason for that is we want to make it very low risk. Yep. So if a fund wants to use CoinRoutes, and we've done studies. So we did a study for one of our customers where we saved them, compared to optimal routing, i.e. the so-called dumb routing, get the whatever you can get based on what you see. We saved them about 29 basis points, about almost $500,000 on about $160 million worth of trading. And so our target is we charge 5 basis points. And my theory is simple. If we're saving people 10, 20, 30 basis points, then we charge 5. They're to the good. We don't put any other fees in there. And as a result, it's a very low risk thing for people to try. It, of course, does require you to set up software and run it, but it makes sense to do that. That way we're aligned with our customers.
So help us understand kind of, you mentioned the dividing line between where you guys are and Tagomi, definitely complementary services and maybe some overlap, but generally speaking, Is it going to be the large asset managers, the large funds that start to earmark some of their AUM for crypto trading that come to you? Because hypothetically, those groups would probably not want to outsource for a much higher fee all of those core capability,
I think that's probably true, but our target audience is frankly the active traders. Anyone who's trading more than $1 million worth of crypto a month will save money net after paying us and have a significantly more information. I mean, we see things that other people don't see because unlike one of the big differences in between crypto and FX, for example, or equities, is in both of those two asset classes, if you're looking at 10 price levels on the bid and 10 price levels on the offer, you see the market. You know which way the book is leading. If you're in crypto, you need to look quite literally 1,000 price levels on each side, which we are capturing. So we have what I call a pressure indicator that people can build out of our software that says, okay, well, where's the imbalance in the book? I mean, everyone's seen Coinbase Pro, GDAX before them, put their book shape thing, which is cool, but it's sort of like looking at, driving down a road, looking through 20% of your windshield.
Yep.
Because their book might not be anything to do with where the overall imbalance is. You need to aggregate all the books, and so we have the ability to do that. So we have a lot of data which is useful for people as well. But yeah, you're right. I mean, we think that people who are actively trading, it's a pretty good solution because it allows them to trust it. I think the bulge bracket firms, when they get into this, are not going to want to trust their assets to a firm that isn't capitalized with a B, as in billions of dollars in front of their name. And so for us as a startup, it was absolutely vital for us to build a model where people didn't have to trust us with their assets.
Yep. Makes a ton of sense. So where are you right now, right? Is this, how many clients are using this? Where are you in the life cycle of the company?
We're in the beginnings of the hockey stick. So we have, on a given day, anywhere from 4 to 6 clients using the system. On a given day, we've traded as much as $30 million through the system in one day. We've traded it obviously as little as 0, and people are like some Sundays no one trades. Average probably is around $4, $5, $6 million of value through the system. We, on average, any given day, it's trading anywhere from 12 to 20 different currency pairs. What's interesting about us is we cover, right now we're over 250 different pairs that we support. We add them on a day's notice if people want them. They're easy to add. It's just a question of we don't add everything because there's a lot of overhead and collecting thousands of price levels even on illiquid coins. So, we add them when people want them. We're just in the process of getting that. We're going to announce within 2 weeks a strategic investment from a large client of ours. And when we announce that, then that kind of breeds more trust, et cetera, et cetera. So we're in that kind of hockey stick level. We're way past the PowerPoint level, though. I don't even bother with PowerPoints. We just do demos and we show people that it works. But we're out there and we're signing people up, so that's where we are.
So that's a billion, maybe a little bit more annualized in terms of trading volume. Still a very, very small fraction of what's actually getting traded. So Bitcoin on a given day is several billion just by itself, right? Leaving out the other assets. How much volume do you think is going to move through systems like CoinRoutes within the next 18, 24 months, right? So I know that there are other folks that are working on these types of tools. Institutional investors have to prove best bid and basically you filled an order, best execution of these orders. And that traditionally has been a bit of a holdup, right? So it's what's the reference data that you're using to mark your book. How do you do custody? That's kind of getting solved by a different group of folks. And then it's best execution. It still seems like a very small percentage of the market that is actually getting filled at best execution.
I think that look, at the end of the day, I don't know the time frame. I can remember, and I'm sorry for the storytelling, but it's actually very relevant. So I can remember, because I'm old, the people in the audience of this will probably have to go back to the history books to remember something called the crash of 1987. But after the crash of 87, when the market dropped 25%, which to crypto folks is like, oh, okay, fine, that's Tuesday. But it dropped 25%, shut down markets all around the world. There was a commission investigating what happened. And because I built the first program trading system, I was one of the people to testify. So I was in a room with a bunch of technologists who basically, they were all convinced within a few years, maybe 2-3 years, everything would trade electronically.
Mm-hmm.
And I'm like shaking my head saying, yeah, it could, but there's a lot of money stopping it from trading electronically. And it actually ended up taking 19 years from that date before everything was trading electronically as far as that goes. So I don't know about 12 to 24 months, but I can tell you that when the markets are evolved to the point where institutions are, don't think that it's a frontier anymore, it'll be 80% will trade electronically.
Yep.
Which is right now, I think if we're lucky, it's 20.
Interesting. What are these systems? What could the impact be for these types of trading tools on the fees, the maker-taker fees that the exchanges themselves charge? Because right now, they're still making money hand over fist from a predominantly retail audience. They might have large market makers that they work with that get preferred terms, but there hasn't, other than competition amongst the exchanges for market share, there hasn't seemed to be that much competition on fees.
Yeah,
This brings that to another level because it's not a want, it's a need.
Yep.
To execute at the lowest price. So how do you think about the impact that this has on the Binances, the Coinbases of the world at scale, just the move to electronic trading? Or is it a wash because at that point there's going to be so much more volume that it evens out?
I think it's really interesting. Just taking those two examples shows you is different. I mean, Binance, if you trade with BNB, their rack rate is 1/6 Coinbase's rack rate. So Binance has already proven that when you cut fees and make it economic, you gain volume. So, I think that's perfectly reasonable. I'd say on a blended basis, I would expect what will happen in crypto is exactly what happened in other asset classes, which is more or less on a blended basis, costs will drop by about 90%. So I think 1/10 of today's fees will be there. But at the same time, I think volumes will jump by 10x.
And that might not necessarily trickle down to the retail, right? Because you can keep fees.
I don't know, Charles Schwab and E-Trade, what if you look at the commission rates that were being charged, they dropped the same. I mean, as electronification happened in every market, two things we saw, and it's actually kind of interesting, but in all cases, you can go through it, you can look at it, and you can see physically commission rates dropping and fees and other sorts of things dropping, except for market data, which is a totally different kettle of fish, but blended fees dropping more or less by 90%. But when electronification happens, volumes increased basically also by 90%. So the net amount of wallet didn't really go down that much. It was just done differently, which is, by the way, the big news story this week, Deutsche Bank, laying off equities. I mean, they cluelessly are blaming it on competition to Morgan Stanley and Goldman Sachs, and they're ignoring the competition that they got from Virtu and Citadel and other small, GTX, other smaller electronic firms where they were the ones who were eating the lunch. They were effectively the termites in their superstructure, right? And so, profit margins come down for someone whose model is based on that. So will business models need to adapt? Absolutely. Will volumes go up and will the asset class become more attractive to people as a result? Absolutely.
Yep.
Is one of the things that will drive that the ability of technology such as we're doing at CoinRoutes and others are doing? Absolutely. Is it necessary? Yes. Is it sufficient? No. There are other things that have to happen. Other ways of doing, pan-exchange custody, for example, because one of the problems that people have is, interestingly enough, a lot of the consumers, a lot of the traders of Bitcoin are not price sensitive, which is really weird if you think about it. They're more concerned about, I'm not going to give you mine until I get the cash and then the escrow changes hands and all of that. Whereas in other asset classes, people don't worry about that. There's trusted providers. Once you're in with trusted providers, you do it what's most economically efficient. That will happen too, but that's another one of the reasons why it might be stickier on the price side for a while.
It was interesting that one of the first things that you brought up when you walked in, we were talking about things that we could cover, was on the regulatory front, right? And Messari, our whole day, we think about the SEC, right? And all these kind of long tail of token projects that are trying to figure out how to operate in the US and kind of release these tokens. It doesn't feel like, your day-to-day is so much focused on the SEC. It feels like it's more about the CFTC and the rest of the alphabet soup. Where do you get frustrated from a regulatory standpoint?
I think that, well, there's a couple.
I'm going to try to get you in trouble here because
that's okay. Some of my friends down in Washington know my feelings. I don't hide them. I was talking with one of the commissioners a couple weeks ago, and I basically told him point blank that when we were specifically looking at VC investors, and we've just closed an investment round, and maybe we'll raise some more money at the end of the year, but we're not actively killing ourselves for investment, that one of the first things that every investor said to us is you have to establish an overseas subsidiary. Mm-hmm. In fact, you might want to move overseas. And when you tell people, I told Congressman, one of the congressmen who was a co-sponsor of the Token Taxonomy Act and one of the commissioners this, their antennas perked up. It's like, okay, we know you don't want to do that, and so that's kind of a bad thing. Well, that's the reality. I mean, I look at your article yesterday on the grayscale and a trading strategy for that. And I've known about this. I have friends who are doing that strategy for the last year, but okay. But the fact is, why would we have a regulatory regime that effectively means that only rich people can do a strategy?
And just for those that are not yet subscribers, unfortunately, to our research newsletter, you're referring to a piece that I wrote on Grayscale's investment trust, which is its own different animal.
Yep.
But in short, accredited investors are able to create new shares in the trust and then gain liquidity through OTC markets, which is not an ETF, but they can do so after a year and a day using something called Rule 144, and essentially sell to retail investors at a 35% premium to what the underlying value is.
Yep.
And then folks can recycle this kind of year in, year out if they're accredited and they can actually go through that process. Right. I think for many investors, no one thought that this could have possibly persisted for this long.
Yep.
At least I didn't. At that level, but that premium has existed for quite some time.
Yeah.
So, but that is a good example.
Right. But the point that I'm making here is, the SEC has been intransigent on the Bitcoin ETF, and there are some reasons. Some of the people who have proposed ETF structures have done it poorly. I have a big problem with the notion that you should rely on market maker quotes to tell you where the NAV is, because market makers, and I was one for 10 years. So I can tell you from a first-hand point of view, my quote is going to reflect my position, and it shouldn't. The price, it should reflect the quote that's being used by the public should be the full supply and demand, not individual market maker positions. But be that as it may, the fact is, with our technology at least, you can see far more in the transparency of the underlying for a Bitcoin ETF than you can for gold or silver, not forget natural gas or oil. I mean, significantly more transparency. So the fact that the SEC keeps saying no because they don't like the way the market structure works for what they recognize to be an underlying spot retail asset, they're not allowing the ETF, means that people are either forced to buy things like the Grayscale Trust at a very large premium, which of course means eventually they lose money, or worse, they go overseas, or worse still, they take on risks that they don't understand by trading futures. And so to me, that frustrates me. I think that's just a really bad set of decision making. I understand why they started that way, but at this point, I think those reasons are gone. Certainly, if you have the right technology, those reasons are gone.
I mean, that's more kind of macro in scope. Is there anything in particular that affects your business from a regulatory standpoint?
Oh, sure. I mean,
that might not be as obvious.
Well, yeah. The single most obvious thing is people ask us, why don't we set up our own accounts? Why don't we handle customer funds and do it for them? Because we could do it for ourselves and we can show how the technology works. And the answer is... Which is
basically Tagomi's model.
Yeah, I don't have $10 million in my back pocket to go through 50, or let's say a critical mass of 25 states, MTL licenses, federal money transfer licenses, banking charters, CFTC, everything. If you look at what the money that was spent to invest in some of these businesses that looks sort of and feels sort of similar to ours, it's an enormous percentage on regulatory. So we don't want to do that. So we're staying as a software company, and that definitely limits our flexibility. There's no two ways about it. The other thing is when you look at what the regulators do, the whole thing with Bittrex, knock them out of New York, or what's going on. Well, what does that mean? It means that our headquarters is California, so for us it's not that big of a deal, but there's exchanges as US citizens that we can't model. So we need to set up an overseas subsidiary to get accounts to be able to verify that our technology works with those exchanges. So that's a frustration. I mean, yeah, there's ways around it, and we have found those ways around it, but it's frustrating because it effectively means that you have less professional people. And my largest frustration is to do with potential clients.
Mm-hmm.
So there probably are hundreds, but I've talked to about a dozen broker-dealers that would love to offer agency trading services for crypto to trade, buy and sell Bitcoin and some tokens, etc. And they have been frustrated because the SEC and FINRA isn't going to let them do it. Now, that's interesting in and of itself, but if you think about what does that mean? That means that people who want to hire a trusted agent have to look outside the broker-dealer community. Outside the broker-dealer community, people don't have a clue about best execution. They don't have a clue about the need for segregating customer assets. They don't understand fiduciary responsibilities. I mean, like I've had in Series 24 and everything on down, the alphabet soup of all this stuff, and the stuff you have to learn about. You may not trust Wall Street, but the alternative to non-Wall Street is what we had back before the Great Depression. And so by a matter of complete unintended consequence, what FINRA and the SEC are doing is forcing people to use the exact archetype of agents that they stopped and put out of business before the Great Depression, because they're stopping broker-dealers who at least have the ethos and follow the principles of Best X. They're not letting them establish that as a business, which to me is absolutely irresponsible and counterproductive. So, yes, you want to get me in trouble, that's cool. But I have said this personally to Robert Cook, who runs FINRA, and he knows I feel this way.
The most interesting thing about what you said, as a software company, you have to set up a subsidiary just to get the data feeds?
No, not to get the data feeds, but to be able to, because we offer algorithmic trading solutions. So let's say a customer of mine comes to me and says, I want to trade with OKEX. And when you use CoinRoutes, you don't have to actually have multiple exchange accounts. That's sort of a myth. Let's say you wanted to trade on OKEX. I'm picking them because you have to be non-US to have that account. So what do we need to do? We need to find a friendly customer who will let us experiment with their accounts to test to make sure our algorithms perform as we expect them to perform. One of the interesting things about crypto exchanges are there are nuances to trading with every exchange. We know more about the inner workings of the APIs at multiple of these exchanges than the exchange people do themselves. I have actually had to educate the biz dev people at multiple exchanges about, this exchange, if you get a cancel back message back, you could still get a execution subsequent to that. And here's why, and here's the sequencing. So we have to get into that level of detail. To do that, there's no test systems in these exchanges. You have to use your own money. So we use ours when we can, but we have to get, and it doesn't take a lot of money. I mean, you can trade for a few $100 of, fractions of whatever, but you need to get that nuance done. So yes, we need to do that. And so that's been somewhat frustrating. That's why we were set up overseas to do it, and that's the reason.
Interesting. So, looking ahead to the next, year, couple of years, what do you think are going to be some of the biggest changes in market structure in Bitcoin and Ethereum? And will there be really anything to pay attention to outside of those two assets? From an institutional standpoint, or for the foreseeable future, is that really where the lion's share of the action is?
Well, yes, it's where the lion's share of the action is. B, however, one of the things we find is that what happens in Bitcoin trickles down towards Ethereum and moves down towards your favorite XRP and others.
It's the shitcoin waterfall.
Yeah, we'll call it whatever you'd like to call it. The fact is I'm actually writing a piece about altcoins. It perturbs me that people lump everything other than Bitcoin and Ethereum into altcoins. Well, the reality is there's wide differences, not just between them, but just in terms of what they are. Some of them are literal altcoins. So, altcoins, Litecoin is an altcoin. It's basically, what is it? It's, it is trying to be a store of value like Bitcoin is. That's the only thing it can do, right? There's, smaller ones like BitGreen, which is trying to be a environmentally safe, version of Bitcoin. Then, but that's a small percentage. Most of what are altcoins are tokens invented supposedly to support an ecosystem, and the vast majority of those have no ecosystem to support. So there are these tokens looking for a use case, as opposed to BNB, which is done very well because there is a use case, right? So there's a use case in an ecosystem. So when people look at altcoins and they look at the group, the ones that never should have existed in the first place because you could have used Bitcoin or Ethereum or Stellar or XRP or some other existing public blockchain inside your use case, those ones are on the slow road to nowhere, right? And they keep going down. Bitcoin rallying doesn't matter. The ones that actually have an ecosystem that are developing, that's relevant, right? Because that's the business. And so what we find, however, is the market structure of those altcoins is remarkably similar to the way that Bitcoin and Ethereum traded a couple of years ago, which is to say wider spreads, no coordination. And that's why we actually think that trend will be dropping, because we can show people tremendous benefits in trading with knowledge of the market in altcoins. Now, the reason why there's a bigger benefit in altcoins to using software like ours is because in Bitcoin, there are market makers who you're going to lose dollars, tens of dollars, and in rare cases, hundreds of dollars in Bitcoin, which is still, a percent or fractions of a percent. In altcoins, the difference between multiple exchanges can be significantly greater than that. And so keeping yourselves in line, being aware, that's kind of a big deal. And so we think that the technology is really important for that. And by the way, the market is evolving. Like every month, things get a little bit better, a little bit tighter, but there's a little long way to go.
Well, there is a long way to go, so we'll have you on again, and hopefully in a few months we'll be able to talk about the next major topics of conversation, which I'm sure are probably going to be some major money managers or hedge funds or maybe even larger asset managers moving into the space. It's my prediction. I think we're both betting on that pretty heavily. Have a ton of skin in the game there. But in the meantime, thank you so much for coming on. I think hopefully our users learned a lot here. And just as a reminder, we are going to be working with Blockworks Group going forward. So this is live stream today. We're going to continue to do live streams, but these are going to be packaged up into a nice, neat little box for a podcast that you can consume anywhere that you like to listen after the fact. So thanks again for tuning in. Dave, thank you. And we'll see you again real soon for Unqualified Opinions. Peace.